Section 1.1 to 1.3 Dollar Cost Averaging. 1.1 Definition and Significance. Dollar cost averaging, DCA, is an investment strategy that involves regularly investing a fixed amount of money into a particular asset or investment portfolio at predetermined intervals, regardless of the asset's price or market conditions. This strategy is commonly associated with long-term investing. The process of dollar cost averaging is relatively straightforward. An investor selects a specific amount of money to invest regularly, such as monthly or quarterly, and commits to investing that amount consistently over a period of time. This consistent investing approach means that sometimes the investor will buy more shares or units when prices are low and fewer shares or units when prices are high. The primary goal of dollar cost averaging is to mitigate the impact of market volatility on investment returns. By investing at regular intervals, the strategy helps to reduce the risk of making poor investment decisions based solely on short-term market fluctuations. It takes advantage of the market's natural price fluctuations by buying more shares or units when prices are low and fewer when prices are high, thereby potentially lowering the average cost per share over time. Dollar cost averaging can be particularly beneficial for long-term investors for several reasons. Disciplined investing. It instills discipline by encouraging investors to maintain a consistent investment plan and avoid impulsive decisions driven by short-term market movements. Averaging out market highs and lows. By investing at regular intervals, investors buy more units when prices are low, potentially lowering the average cost per unit over time. This strategy helps reduce the impact of market volatility on the overall investment performance, reducing the risk of mistiming the market. Timing the market perfectly is challenging, and investors risk missing out on potential gains if they try to time their investments. Dollar cost averaging helps mitigate this risk by spreading investments over time, emphasizing long-term goals. Dollar cost averaging is often associated with long-term investing, as it encourages investors to take a patient approach and focus on the overall growth potential of their investments. It's important to note that while dollar cost averaging can be a useful strategy for many investors, it does not guarantee profits or protect against losses. Investors should carefully consider their investment objectives, risk tolerance, and time horizon before implementing any investment strategy, including dollar cost averaging. Additionally, it's essential to choose suitable investments based on individual circumstances and consult with a financial advisor if needed. Averaging down is an investment strategy that involves buying more shares or units of a particular investment when its price has declined since the initial purchase. This strategy is based on the belief that the investment's price will eventually recover, resulting in potential gains for the investor. Averaging down can have potential advantages, although it also carries risks that should be considered. Here are some potential advantages of averaging down: lowering the average cost. By buying more shares or units at a lower price, averaging down can lower the average cost per share or unit of the investment. If the investment eventually recovers and its price rises, the investor may benefit from a higher overall return. Increased potential for capital appreciation. When an investment's price has declined, there may be an opportunity for greater capital appreciation if the investment rebounds. By buying additional shares or units at a lower price, investors can potentially benefit from a larger percentage gain when the price recovers. Potential for higher long-term returns. Averaging down is often associated with a long-term investment perspective. By investing in a fundamentally sound investment that has temporarily declined in price, investors may benefit from the potential for higher returns over the long run. Confidence in the investment. If an investor believes in the long-term potential of a particular investment, averaging down allows them to express their confidence by increasing their holdings at a lower price. It can be a way to capitalize on temporary market inefficiencies or perceived undervaluation, while averaging down has its potential advantages. It's important to consider the associated risks. Declining investment value. Averaging down can result in additional losses if the investment continues to decline in value. It's crucial to carefully assess the reasons behind the initial price decline and evaluate the investment's prospects before deciding to average down. Increased exposure and risk. By buying more shares or units, investors increase their exposure to the investment. If the investment doesn't recover or experiences further declines, the potential losses can be magnified. Limited capital allocation. Averaging down ties up additional capital in a specific investment, which may limit the ability to invest in other potentially attractive opportunities. Market unpredictability. While averaging down can be an effective strategy in certain situations, it assumes that the investment will eventually recover. However, market conditions and the performance of individual investments are unpredictable, and there is no guarantee that a declining investment will rebound. Before employing the averaging down strategy, investors should carefully analyze the investment's fundamentals, assess the reasons behind the price decline, and evaluate their risk tolerance and investment objectives. It's essential to diversify investments, set appropriate stop-loss levels, and consider seeking advice from a financial professional when making investment decisions. 1.2 Benefits of dollar-cost averaging. Market volatility refers to the rapid and significant price fluctuations in financial markets. It can have a significant impact on investment returns and create uncertainty for investors. While it is not possible to completely eliminate market volatility, there are several strategies that can help mitigate its impact on investment returns. Diversification. Diversifying your investment portfolio across different asset classes, industries, and geographic regions can help reduce the impact of market volatility. By spreading your investments across a variety of assets, you can potentially offset losses in one area with gains in another, thereby smoothing out overall returns. Asset allocation. Allocating your investments strategically among different asset classes, such as stocks, bonds, and cash, can also help manage market volatility. Different asset classes tend to perform differently under varying market conditions. By having a well-balanced portfolio, you can potentially reduce the risk associated with any single asset class and increase the stability of your overall returns. Dollar-cost averaging. As discussed earlier, dollar-cost averaging involves investing a fixed amount of money at regular intervals, regardless of market conditions. This strategy allows you to buy more shares or units when prices are low and fewer when prices are high. By taking advantage of market fluctuations, dollar-cost averaging can potentially reduce the impact of short-term market volatility on your investment returns. Long-term investing. Taking a long-term perspective can help mitigate the impact of short-term market volatility. By focusing on your investment goals and maintaining a disciplined approach, you can ride out temporary market fluctuations and benefit from the potential growth of your investments over the long term. Trying to time the market or making impulsive decisions based on short-term volatility can often lead to suboptimal results. Risk management techniques. Implementing risk management techniques, such as setting stop-loss orders or using trailing stops, can help protect your investments during periods of heightened volatility. These techniques allow you to automatically sell a security if it reaches a predetermined price level, limiting potential losses. Regular portfolio review. Regularly reviewing and rebalancing your investment portfolio is crucial in managing market volatility. Rebalancing involves adjusting your portfolio's asset allocation to bring it back in line with your target allocation. By periodically rebalancing, you can ensure that your portfolio remains aligned with your risk tolerance and investment objectives. Education and professional advice. Staying informed about market trends, economic indicators, and investment strategies can help you make more informed decisions during periods of market volatility. Seeking advice from a financial professional or working with a certified financial planner can provide valuable insights and guidance tailored to your individual circumstances. It's important to remember that market volatility is a natural part of investing, and it cannot be completely eliminated. However, by implementing these strategies and maintaining a long-term perspective, you can potentially mitigate the impact of market volatility on your investment returns and work towards achieving your financial goals. Taking advantage of market downturns by buying more shares at lower prices is a strategy known as buying the dip or contrarian investing. It involves purchasing additional shares or units of an investment when its price has declined significantly. This strategy can potentially provide several benefits. Lower average cost. By buying shares at lower prices during a market downturn, you can reduce the average cost per share of your investment. This can potentially increase your overall return when the market eventually recovers. Increased potential for capital appreciation. When you buy shares at lower prices during a market downturn, you have the potential to benefit from greater capital appreciation as the market recovers. As the investment's price rises, the gains you realize can be larger compared to if you had bought at higher prices. Long-term value opportunities. Market downturns can create opportunities to invest in quality assets or companies that may be temporarily undervalued. By conducting thorough research and identifying investments with strong fundamentals, you can take advantage of these opportunities and potentially benefit from their long-term growth. Building a resilient portfolio. Buying the dip allows you to add to your investment positions when prices are low. This can help build a more resilient and diversified portfolio over time, as you acquire assets at different price points and potentially reduce the overall risk of your holdings. However, it's important to approach buying the dip with caution and consider the following: research and due diligence. Thoroughly research and analyze the investment you plan to buy during a market downturn. Ensure you understand the reasons behind the price decline and assess the investment's long-term potential. Risk management. While buying the dip can be an effective strategy, it does not guarantee that the investment will rebound or that losses won't occur. Set appropriate stop-loss levels to limit potential losses and consider your risk tolerance before increasing your investment during a downturn. Investment horizon. Buying the dip is often a strategy suited for long-term investors who can withstand short-term market volatility. Ensure that the investment aligns with your long-term investment goals and time horizon. Diversification. Maintain a well-diversified portfolio to mitigate risks associated with individual investments. Avoid concentrating your investments solely on a few positions, even during market downturns. Consultation and professional advice. If you're uncertain or lack expertise, consider consulting with a financial advisor or professional who can provide guidance tailored to your specific circumstances and investment goals. Remember that market timing is challenging, and it can be difficult to accurately predict market bottoms. Even when buying the dip, it's crucial to maintain a disciplined approach, focus on long-term value, and avoid making impulsive investment decisions based solely on short-term market fluctuations. A disciplined and systematic approach to investing involves following a well-defined investment strategy and sticking to it consistently over time. It emphasizes the importance of long-term planning, consistency, and avoiding emotional decision-making based on short-term market fluctuations. Here are key elements of a disciplined and systematic approach to investing. Investment plan. Start by developing a clear investment plan that aligns with your financial goals, risk tolerance, and time horizon. Your plan should outline your asset allocation strategy, target investments, and guidelines for portfolio rebalancing. Asset allocation. Determine an appropriate asset allocation that reflects your risk tolerance and investment objectives. Allocate your investments across different asset classes, such as stocks, bonds, cash, and alternative investments, based on their expected risk and return characteristics. Regularly review and rebalance your portfolio to maintain the desired asset allocation. Regular investing. Establish a consistent schedule for investing, such as monthly or quarterly, and stick to it. Regular investing, such as through dollar-cost averaging, helps smooth out the impact of market volatility and reduces the risk of mistiming the market. Diversification. Build a diversified portfolio by spreading your investments across different asset classes, sectors, and geographic regions. Diversification helps mitigate risks and reduces the impact of poor performance in any single investment. Research and due diligence. Conduct thorough research and analysis before making investment decisions. Understand the fundamentals of the investments you consider, evaluate their historical performance, and assess their long-term growth potential. Risk management. Implement risk management techniques to protect your investments. Set appropriate stop-loss orders or use trailing stops to limit potential losses. Regularly review and adjust your risk management strategies as needed. Long-term focus. Maintain a long-term perspective and avoid making impulsive decisions based on short-term market movements. Remember that investing is a marathon, not a sprint. Stay focused on your long-term goals and resist the temptation to react to short-term market fluctuations. Continuous learning. Stay informed about financial markets, economic trends, and investment strategies. Continuously educate yourself on investing principles and seek to enhance your knowledge and understanding of the financial landscape. Professional guidance. Consider seeking advice from a qualified financial advisor who can provide personalized guidance and help you navigate the complexities of investing. A professional can assist in developing and implementing a disciplined investment strategy based on your individual circumstances. A disciplined and systematic approach to investing helps to reduce emotional decision-making, minimize the impact of market volatility, and increase the likelihood of achieving long-term investment goals. By following a well-defined plan, consistently investing, and staying focused on the big picture, you can build a solid foundation for investment success. 1.3 dollar cost averaging versus lump sum investing. When deciding between dollar cost averaging and investing a lump sum, it's important to consider your individual circumstances, risk tolerance, and investment goals. Here's a comparison of the two approaches: dollar cost averaging, regular investing. With dollar cost averaging, you invest a fixed amount of money at regular intervals over a period of time. This approach helps smooth out the impact of market volatility as you buy more shares or units when prices are low and fewer when prices are high. Mitigating timing risk. Dollar cost averaging reduces the risk of mistiming the market. Instead of trying to predict the best entry point, you invest consistently regardless of short-term market movements. Emotional discipline. Dollar cost averaging encourages a disciplined and systematic approach to investing, minimizing emotional decision-making based on short-term market fluctuations, suitable for uncertain markets. Dollar cost averaging can be particularly beneficial during periods of market uncertainty, as it allows you to gradually enter the market without committing a large sum at once. Investing a lump sum. Immediate market exposure. Investing a lump sum gives you immediate exposure to the market and potential returns. If the market rises, you benefit from the full upside potential. Time in the market. Investing a lump sum allows you to have a longer investment horizon. The longer your money is invested, the greater the potential for compounding returns. Potential opportunity cost. If the market declines shortly after investing a lump sum, there is a risk of immediate losses. However, if the market rises, investing a lump sum upfront may result in higher returns compared to dollar cost averaging, suitable for a longer time horizon. Investing a lump sum is often more suitable for investors with a longer investment horizon who can tolerate short-term market fluctuations. Factors to consider. Risk tolerance. If you have a higher risk tolerance and are comfortable with short-term market volatility, investing a lump sum may be appropriate. If you prefer a more gradual entry and want to minimize the impact of short-term volatility, dollar cost averaging may be a better fit. Market conditions. Consider the current market conditions. If the market is experiencing heightened volatility or uncertainty, dollar cost averaging may provide a sense of comfort. If the market is stable or trending upward, investing a lump sum may be advantageous. Individual circumstances. Assess your individual financial situation, investment goals, and cash flow availability. If you have a large sum of cash available and don't need it for other purposes, investing a lump sum may be feasible. If you have a regular income and prefer to invest smaller amounts over time, dollar cost averaging may align better with your circumstances. It's worth noting that both approaches have their pros and cons, and there is no one-size-fits-all answer. Some investors may choose a combination of both approaches, investing a portion as a lump sum and using dollar cost averaging for the remainder. Ultimately, the decision should be based on your personal circumstances, risk tolerance, and investment objectives. Consulting with a financial advisor can provide valuable insights and help you determine the most suitable approach for your situation. Certainly. Let's delve into the potential advantages and drawbacks of both dollar cost averaging and investing a lump sum. Dollar cost averaging. Advantages. Risk mitigation. Dollar cost averaging helps mitigate the risk of investing a large sum at an unfavorable time. By investing consistently over time, you reduce the impact of short-term market volatility and potentially minimize the risk of making poor timing decisions. Emotional discipline. Dollar cost averaging encourages disciplined investing, as it removes the temptation to make impulsive investment decisions based on short-term market movements or emotions. Lower average cost. By buying more shares or units when prices are low and fewer when prices are high, dollar cost averaging can result in a lower average cost per share. This can potentially enhance your returns when the market recovers. Long-term perspective. This approach aligns well with a long-term investment strategy, as it emphasizes consistency and gradual accumulation of shares or units over time. Drawbacks. Opportunity cost. While dollar cost averaging can reduce the risk of investing a lump sum at an unfavorable time, it also means that you may miss out on potential gains if the market experiences significant upward movements during the period you are investing. Gradually, delayed full market exposure. Since dollar cost averaging involves investing over time, it may take longer to have your full investment exposed to the market. This can result in missing out on some potential returns if the market experiences a substantial upward trend during the accumulation period. Transaction costs. If you're investing in assets that incur transaction fees or commissions, the repeated purchases associated with dollar cost averaging may result in higher transaction costs compared to investing a lump sum. Investing a lump sum. Advantages. Immediate market exposure. By investing a lump sum upfront, you immediately gain exposure to potential market returns. If the market rises, you have the opportunity to benefit from the full upside potential. Longer investment horizon. Investing a lump sum allows for a longer investment horizon, potentially maximizing the benefits of compounding returns over time. Potential for higher returns. If the market experiences a significant upward movement shortly after investing a lump sum, you have the potential to earn higher returns compared to dollar cost averaging. Drawbacks. Timing risk. Investing a lump sum exposes you to the risk of making poor timing decisions. If the market declines shortly after investing, you may experience immediate losses. Emotional impact. A lump sum investment can be psychologically challenging, especially if the market experiences volatility or downturns soon after. Emotional reactions may lead to panic selling or poor decision-making. Increased market exposure. Investing a lump sum means that your entire investment is immediately exposed to market volatility, which may result in higher short-term fluctuations and potential losses if the market declines. Ultimately, the choice between dollar cost averaging and investing a lump sum depends on your risk tolerance, investment goals, and individual circumstances. Some investors may find that a combination of both approaches suits their needs. It's advisable to carefully consider your financial situation and consult with a financial advisor who can provide personalized guidance based on your specific circumstances. When deciding between dollar cost averaging and investing a lump sum, consider the following factors. Risk tolerance. Assess your risk tolerance and comfort level with market volatility. Dollar cost averaging may be more suitable for risk-averse individuals who prefer a gradual approach and want to reduce the impact of short-term market fluctuations. Investing a lump sum may be appropriate for individuals with a higher risk tolerance and the ability to withstand short-term market volatility. Market conditions. Consider the current market conditions and outlook. If there is high uncertainty or volatility in the market, dollar cost averaging may provide a sense of security by spreading out your investments over time. In contrast, if the market is stable or has positive growth prospects, investing a lump sum may be more advantageous to capture potential immediate gains. Investment horizon. Evaluate your investment horizon and time frame. Dollar cost averaging is typically associated with longer-term investments, as it involves gradually accumulating shares or units over time. Investing a lump sum may be more suitable for longer investment horizons, allowing for potential compounding returns over a longer period. Cash availability. Assess your available cash for investment. If you have a significant sum available, you may consider investing a lump sum if it aligns with your risk tolerance and investment goals. On the other hand, if you have a regular income stream and prefer to invest smaller amounts over time, dollar cost averaging may be more practical. Opportunity cost. Consider the potential opportunity cost of each strategy. Dollar cost averaging may provide the benefit of potentially buying more shares or units at lower prices during market downturns. However, investing a lump sum upfront may allow you to participate in potential immediate market gains if the market experiences an upward trend. Psychological factors. Reflect on your emotional response to investing. Dollar cost averaging can help mitigate the impact of emotional decision-making by removing the need to time the market. Investing a lump sum requires confidence in your investment decision and the ability to stay disciplined during market fluctuations. Transaction costs. Evaluate the transaction costs associated with each strategy. Dollar cost averaging typically involves multiple smaller transactions, which may result in higher transaction fees or commissions compared to a single lump sum investment. Consider the impact of transaction costs on your overall investment returns. Professional advice. Consult with a financial advisor or investment professional who can provide personalized guidance based on your specific circumstances. They can help assess your financial goals, risk tolerance, and market conditions to determine which strategy aligns best with your needs. Remember that there is no one-size-fits-all answer, and the choice between dollar cost averaging and investing a lump sum depends on your unique circumstances and preferences. Consider these factors carefully to make an informed decision that aligns with your investment goals and risk tolerance.